Hello and welcome to Wall Street Vision, a show that explores investment ideas from the best investors in history. I'm your host, Vlad. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. In today's episode, we're going to go over the difference between investing and speculating. But first, I want to start with a couple of stories. There's this book by Monish Pabrai called The Dando Investor, and the book describes a great rags to riches story about this guy named Papa Patel. So Papa Patel immigrates to the US from Uganda in the 70s. He has a wife and 3 teenage kids. His English is not that great, so the best job he can get is bagging groceries for minimum wage. The whole family lives in a tiny apartment, and they save as much money as they can. Papa Patel works bagging groceries, but he has a deep, burning desire to succeed financially. He wants to live the American dream that he keeps on seeing in movies. He sees this 20-room motel for sale at what looks like a really cheap price. He saves every dollar he can and gets a loan from some close relatives. In the end, he raises $5,000 for the down payment of the motel. The idea is, if the whole family lives in the motel, they don't need to pay rent, and they work at the motel, so they don't need to pay for employees either. This allows the motel to have the lowest operating cost of any motel in the area. Their motel offers the lowest nightly rate per room, and at the same time, they have better profits per room than any of their competitors because they're all working in the motel. This is the 70s, so if Papa and Mama Patel get jobs working full-time, they would earn about $6,000 per year. By comparison, the motel makes about $50,000 per year in revenue. After all expenses, the motel nets over $15,000 a year, plus $5,000 in principal repayment. So that's a $20,000 return on a $5,000 investment. And that return is just in the first year of business. That's a 400% return in 1 year. A motel is an existing, proven business model with a long history of cash flows and profits. It's not rocket science. It's a simple business where the low-cost provider has a huge competitive advantage. Now, the likelihood of this investment succeeding is around 90%. There is a 10% chance that for some reason, Papa Patel is unlucky with the purchase and the motel goes bankrupt, and then the bank gets a hold of the property. Here's another story. This one is from a Wall Street Journal article about day trading. So there's a real estate agent named Sharmila who started trading stocks during the COVID pandemic. She couldn't work as a real estate agent during COVID because of business restrictions. So she read a Trading for Dummies book, watched some YouTube videos, and opened a trading account. Her trading strategy is mostly built around buying stocks that trade for less than $5 per share, and she sells most of them after a day or two. She doesn't buy the more conventional stock picks because those shares are more expensive and their prices don't fluctuate as much on a daily basis. Sharmila says the potential for big gains is bigger with smaller stocks because an increase of a few pennies per share can mean a big percentage gain. She's quite the active trader, and her daily trading volume is several $1,000s each day. Sharmila starts with $25,000 of capital, and she makes $65,000 in profit by early July. If she started trading in early March, that's a 260% return in just 4 months. That looks better than Papa Patel with his 400% return in 1 year. Mind you, Papa Patel and his whole family have to work really hard at the motel for that return. Sharmila is just trading stocks a couple of hours a day on her phone. So what's going on here, and what are some lessons we can learn from those stories? First, let me ask you this. If you could enter a contract to get half of the future earnings of Papa Patel or Sharmila, who would you pick? I'd pick Papa Patel, even though his return is smaller. He's invested in a proven business with a long history of cash flows, and he has a lot of skin in the game. He simply has to make the motel work, or he won't have anywhere to live. Let's break this down a little bit more. The difference between Papa Patel and Sharmila comes down to their approach. It comes down to understanding the difference between investing and speculating. They're both similar, but they're not quite the same. Papa Patel is investing, and Sharmila is speculating. So what do I mean by that? Investing is when you do thorough research before you buy an asset. When you're investing, there's a high probability that your money will be protected, and there's a high probability that you will get an adequate return. Investing is usually boring and unexciting. Papa Patel worked super hard the first year of owning the motel. It's also a proven existing business model that has been shown to work thousands of times. When someone speculates, there's no deep research process, maybe a couple of hours here and there, but usually nothing too in-depth. Speculating has a low probability that money will be protected, and there's a high probability of loss. Having said that, speculating is usually exciting, exhilarating, and it involves a lot of emotions. Sharmila is not a professional investor, and she doesn't seem to have a solid investing philosophy. You can't argue with her amazing return over those 4 months. However, the overall markets have increased by a lot from March to June, so she was lucky to be swimming in a current that flowed in the right direction. One of the best investment books ever written is called The Intelligent Investor. This guy named Ben Graham wrote it, and Ben Graham was Warren Buffett's big mentor. In the book, there's a chapter where Graham talks about the difference between investing and speculating. Here's Graham's definition on investing. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. That quote means that deep research involves really understanding what you're investing in, knowing the history of returns for the asset, and the likely value that the asset will have in the future. Having a high probability that your money will be protected comes down to the fundamentals of the asset that you're investing in. And by the way, the asset can be anything: an actual brick and mortar business, a stock, a mutual fund, a commodity, or maybe an index fund. It could be anything. So it's a very broad definition. A high probability of return means there's a good chance that you'll get your money back, with an added return to compensate you for taking on the investment risk. A good example of investing is when you purchase a diversified mutual fund or ETF in a retirement account. Hopefully you've done your research and understand what product you're buying, and you have a high probability that your money will be protected, and you should get an adequate return if the mutual fund or ETF do well. Now contrast that with speculating. Speculating would be hearing about a hot stock that went up 20% in the last day and investing in it because you believe that trend is going to keep going. People who speculate are not looking at the fundamentals of the asset, and instead they're hoping that someone else will come along who will buy the asset for a higher price. Time horizon is something that usually separates the investors from the speculators. Most speculators try to do a transaction and get out of their position quickly. Sharmila, in our example, would only hold stocks for 1 or 2 days. Investors will usually have a longer-term orientation of at least several months, and in some cases, several years. In Papa Patel's case, he wants to own the motel for a minimum of 5 to 10 years. We talked about Ben Graham, who was one of the best investors. Now, the interesting thing is that Graham wrote that just like there is intelligent investing, there can also be intelligent speculation. Here are his 3 mistakes that people make when it comes to speculating. Mistake number 1, when people speculate when they think they're actually investing. If you're doing both investing and speculating, you definitely want to have a clear separation between the two. And using the language of speculating and investing is super helpful. So you actually want to use those 2 words, the word investing and the word speculating. This instantly lets you frame the potential transaction in the right context. Language is powerful, and using these 2 words properly can instantly help you stay out of trouble. Broadly speaking, if you're buying a motel, it's probably an investment. If you're day trading a penny stock on your phone during your lunch break, it's probably speculation. Mistake number 2 involves people speculating seriously instead of as a pastime. I have a friend who plays cash poker a handful of times per year. He's not a great poker player, but he is a very good investor. I've asked him about his poker games, and he told me this. He said, "Well, look, these are small stakes games where I might lose $50 a night total. If you want to go to dinner, it's going to cost you $50. If you want to go see a basketball game, it'll cost you $50. So this is just my way of having entertainment." So he views the $50 as an entertainment cost, and he's fully aware that it's unlikely to be something that gives him a good return. It's just a fun pastime. Ben Graham says the same thing. Your speculating should be something you do on the side for fun, but never try to make the speculation into a serious venture. Mistake number 3 involves risking more money in the speculation than you can afford to lose. If you're speculating, it can be helpful to assume that your speculation capital will go to zero. I have a friend that has a trading account where he contributes a couple of $1,000s a year. His portfolio in that account is a mixed bag of the biggest meme stocks, and most of these stocks are not profitable. My friend loves this. It's fun for him, and when I ask him about it, he says that he fully expects most of those stocks to have big declines, but it's entertaining, and it also serves a social purpose. At a social event, it's fun for him to discuss the latest hot stock that he's bought. The thing he's doing right is he's fully aware that most of those stocks will decrease in price, and even if the stock goes to zero, he's totally okay with it. Ben Graham writes that you want to keep your speculative funds totally separate from your investment funds. So if you have a retirement account, Ben Graham recommends a separate account where any speculative trades would happen. I hope you found that useful. Thank you for listening, and I hope you have a great day.